According to the latest data released by the National Statistical Office, that is NSO, the real gross domestic product posted a growth of 6.3% year on year in the second quarter of this year, driven primarily by private consumption and investment. This also is in line with our expectations. Going into the third quarter of this year, economic activity continued to gain strength in the month of October. Urban consumption firmed up further, driven by sustained recovery in discretionary spending, especially on services such as travel, tourism and hospitality. Passenger vehicle sales and domestic air passenger traffic posted robust year-on-year growth. Rural demand is recovering as reflected in the pace of tractor and retail two-wheeler sales, with rising farm activity. Investment activity is also gaining traction. Non-food bank credit, and this is something very important, non-food bank credit rose by rupees 10.6 lakh crore during April to November as compared with an increase of 1.9 lakh crore last year. The total flow of resources to the commercial sector, expanded by rupees 14.7 lakh crore during this year up to November as compared with rupees 6.8 lakh crore in the same period last year. On the other hand, the drag from net external demand further accentuated in October as merchandise exports contracted by 12.1% year on year after expanding during the previous 19 months. Merchandise exports expanded by 10% in October. On the supply side, the agricultural sector remains resilient. Rabi sowing got off to a strong start. The area sown so far is 6.8% higher than the normal sown area, and this is the position as on 2nd December this year. The manufacturing PMI rose from 55.3 in October to 55.7 in November. The PMI for the services sector also expanded from 55.1 in October to 56.4 in November. Incidentally, both manufacturing and services PMIs for India in November are among the highest in the world. Construction activity is picking up after the end of the southwest monsoon, as indicated by high growth of steel consumption in the month of October. Going ahead, investment activity will get support from government capex. A pickup in share of fixed assets in total assets of manufacturing companies was visible in the first half of this year. I have given the data in the footnote of my statement, and the statement, as you know, will be uploaded in our website immediately after my statement is over. You could have a look at the numbers. According to our surveys, consumer confidence has further improved. I go on. Manufacturing and infrastructure sector firms are optimistic about the business outlook. Services sector firms also expect activity to expand. In an interconnected world, we cannot remain entirely decoupled from the adverse spillovers from global slowdown and its negative impact on our net exports and overall economic activity. The biggest risks to the outlook continue to be the headwinds emanating from protracted geopolitical tensions, global slowdown and tightening global financial conditions. Taking these factors into consideration, real GDP growth for the current year, that is 2022-23, is projected at 6.8%, with the Q3 at 4.4% and Q4 at 4.2%. The risks are evenly balanced. Real GDP growth is projected at 7.1% in the first quarter of next financial year, that is 23-24, and 5.9% in the second quarter of the next financial year. Now let me highlight and stress that even after this even after this marginal revision in our growth projection for 22-23, as you know, earlier we had projected 7%, now we are marginally moderating it to 6.8% for the current year. Now even after this reduction or revision, even after this revision in our growth projection for 2022-23, that is the current year, India will still be among the fastest growing major economies in the world, and that is something which I think needs to be kept in mind.
If you like the video, do like, comment, share and subscribe.